Good evening, ladies and gentlemen. Thank you for being with us for this webinar today, and good morning to our friends in New Zealand and Australia, the lands down under, and particularly to Daryl and Sage. Thank you, Sage. It's already given me a sound check. Miss Efficiency. You ever want to know the definition of efficiency? Have a talk to Sage one day if you get a chance. She's a wonderful woman, very, very good trader, and on the ball at all times. So great crowd today. Thanks for being with us, folks. We seem to have lots of new friends today, as well as our old friends. Albert, nice to see you here. Brian Coleman up in New York. Going to be my man in New York, I think. Brian, Bill Dallywell, Melbourne. Bill's doing a big investigation into Fractalian for stocks, which is something I know little about, but Bill's a bit of a expert there. Another couple of Bills. Brian Baird. I had breakfast with Brian a couple of weeks ago. It was nice. Darryl and Glennis. Yes, good. Deepak. Nice to see you back here, mate. It's been a while. Donald Trump. I've got a pretty good idea who that'll be. Greg Mapes. Nice to see you again. Chip, glad you're here. Don't forget, we've got a bit of catching up to do with you and your rugby mate, haven't we? And when you get things quieted down over there, Chip, let me know, and we'll catch up on those one-on-ones after the tutorial to get things going. So welcome to everyone. Nice to have you here. John Barnes, nice to have you. John Leeseman, lots of my friend Marcel. Marcel, I hope you're feeling better up there, mate. And nice to see you here. Gosh, Michael Pell. Michael's a mate from Panama. Daryl, you'll remember Michael well. He's actually over in Perth now. I don't know if he's made contact with you or not. Mike Fowler. There's Mike Mitsos from Mike did the tutorial with us in LA. Great to have you here. I like to say there's Peter Batty. I like to say hello to all our old friends. There's Dick Brewster as well. God, I haven't seen you for a while, Dick. Nice to see you here. Rob H., my mate from New Zealand. He's an absolute gun analyst and trader. Lots of people. I'd like to say hello to everyone that I can recognise, and the others, Todd Timmins, an old mate. And usually about this time someone says, "Oh, get on with it," I mean, what the hell? Guys, I have some workmen here doing some work today, so if there's a little bit of noise occasionally, I do apologise. I'm getting some work done on the back of my house here, and the way these things schedule, you've got to fit in with them more than them fitting in with you. But they're very obliging, and they will try as much as possible to keep things fairly quiet while this webinar is on. Sue Lee, nice to see you, Sue. Love having the ladies here. We don't get enough ladies, do we? Need more chicks. I don't know why. I mean, there should be a girls' game. Sage is probably one of our, well, not probably, she's one of our very, very best traders, together with her husband, Daryl, the Mustang man. So, this is a game for all people with a bit of intellect, and I'd like to have more girls around at all times for all reasons. Okay, so let's move on. We've got a ton of things to talk about today. It's been a pretty dramatic week, as I'm sure you all know. And we're going to run through all this, some of the great drama we've had, which I love. I mean, gosh, bring it on. I often say that trading's a bit like long distance yacht races. Sydney Hobart, Sydney Noumea, Los Angeles to Hawaii sort of stuff. That it's mainly periods of long unrelenting boredom, followed by moments of sheer panic and terror. The longer you do this, the more you'll enjoy the panic and terror, because if you get it right, you make an awful lot of money in a very short time. Okay, so this is what we're going to have a look at today, bring you up to date on everything that's happened, and more importantly, let you know what's coming down the track, and specifically give you the points that we need to monitor going forward. There's an old saying in business: if you can't measure it, you can't fix it. And it's much the same with trading, that we need to be able to measure things with a high degree of specificity, I think is the word. I thought I had my tongue around that one before I said it, but apparently I didn't. But we need to be able to measure things with a high degree of precision. How's that? So that we can see what the probabilities are going forward. Because trading at the Daniel Code is very much a rules-based system. We work on nearly all of it is based on a if this then that type of analysis. So I just want to do a recap on gold for you. I had a couple of our clients not understand that we'd called this recent low in gold pretty nicely in a number of ways, both on the charts and on the webinars, and of course the fourth seal, which Frank DB assists me with and has been doing a great job. He's not with us at the moment. I guess it's 2 or 3 in the morning, maybe 4 in the morning in Belgium, but I know he does watch these replays with a high degree of interest. So thanks to you, Frank. We very much appreciate the help you give me and help that pass on to clients. But you should, there's just a quick rerun of what we said in gold to find that recent little low. And this is what the signals have done since then. So the key to this is just stay with the Daniel Code directional signals. Most of them are pretty fantastic. Some of them are not much good. And I always show you everything. I've had people say, oh, look, he only shows us the good stuff. That's not true. I show you everything. And here's one that failed. So there was our buy signal back there. We got a nice 4-day run up until the stochastic got overbought. Then we had a blue line sell signal here where I put this pinky looking spotlight dot. That was a failure. That trade was correct but lost money, which happened all the time in trading. And then we got you back on the buy side here. For the 3-bar run up into the high, and we had a TO3 signal actually issued the day before. It was actually issued for GC. Let me see, the day before that, where the dot is now, and these signals are valid for 2 days. So it was elected the next day. We said thank you very much, and this led into all of the fun last week. We were basically short all of the equities. From Wednesday on last week, we were long gold and then short gold here, as you can see, and we were also short the DX. They were the dominant trades together with our Euro trades, and we just made a massive amount of money, had just fantastic trading. I've got a few points to show you here. I've got a few slides, and then I'm going to move on to the longer term chart, because it's important that we review where these markets are, and I show you the specific signals that you want to be watching out for, because this recent break has the potential to be something much more, and we need to know excuse me, what will be the signs that we are watching for. So this is a GBP USD trade that we had earlier this week. It was a TO3 sell trade, and I spent a lot of time with Matthew talking about this a couple of days ago, just before this trade was elected, and we found 5 different ways that we could have identified that high, but the simplest for all of you is to look at the Daniel Code charts. We had a TO3 sell the day before, where the arrow is. Then we had our key reversal bar right at the Daniel Code blue line, 158.25, just a few ticks away from that, and a key reversal bar, and that was the TO3 sell the second day of, and then of course that trade was elected, down it went, and it's made about $2,700 per one contract into the close today. And you can see that it's bottomed exactly at a blue line. And these numbers, we don't talk enough about these numbers. I know that many of you find numbers boring or difficult. You shouldn't, because I do them for you. But basically, this is where markets turn. Markets turn at these Daniel Code numbers. And so far as I know, after 25, 26 years in the business, they only turn at these Daniel Code numbers. So if you're not getting these numbers, if you're not looking at the charts, then you are losing a significant edge in your trading. In fact, a very basic proposition of your trading is that these markets will run to these numbers all the time. And on the Daniel Code website, there's an archive of the charts I've done over the last 6-7 years, and there's about 32,000 of these charts in there that I've drawn over those years, and you can prove to yourself that what I tell you is correct. This was a Dow trade. I just want to go through what we did last week because it was very nice. It's been a long time since we've had this sort of volatility, which all started off on Wednesday of last week, and in all of the indices, Dow, Russell, S&P, NASDAQ, and DAX, we had sell signals right on the day that you wanted to get in, and then we were just nice enough for the markets to give us 4 days down, some of them very big, and the last one or two sort of getting to the enormous stage. I wanted to just show you what these markets do and some clues about what you do for your exits. So here was your plus sell signal. You had a profitable close on the trade. You got short at the bottom of this bar here. There was your first profitable close. If you were a newish trader and you wanted to get out there, that's fine. That was a valid exit, and you made money. If you were a more seasoned trader, you would have been using a very simple strategy that we recommend to you, and that is that you use a 2-bar trailing stop, which would be, in this case, your stop stays above the highest high of the last 2 completed bars. Make sure you always do this work when the bars have completed. Don't try to be doing this on an intraday basis. And Brian got a string of dollars going across the question page. I think he got a ton of money out of the Dow trade. This trade exactly. And then use a 2-bar trading stop until this stochastic gets oversold, which is down here. It's the blue line you're following. That's the one called %K. Once that gets oversold, you go to a 1-bar trailing stop. What I want to show you is how this market reacted to these blue lines. So this bar here stuck its head through the blue line, closed a bit above it. This bar went all the way down, closed right on its low. Now, as a point of interest, remember, with markets, we're only ever dealing with probabilities. There are no certainties, except the closest thing to a certainty is that markets will only turn the Daniel Code numbers. But it is very unlikely that markets turn when you have a fully extended bar like this that closes at an extreme. Excuse me, in this case, that bar closed right on its low. It is a strong indication that there's more momentum left in the trade. The next bar did the same thing, and we're now up to, this is Friday of last week, and then that bar did the same thing. Now notice neither of these bars are on a Daniel Code number. Okay, so that means that there's almost zero probability of them turning. And I say almost zero because not all of the blue lines are on your chart. In fact, this is the Dow. This is the chart that you don't even see, but I see it. But they're all the same. If you look at any of our US equities markets, and we do charts for the S&P and the Russell, all of these markets react exactly the same. You'll see exactly the same pattern in the Russell and the S&P as I'm showing you here. So look, no blue line, no target recognition there, unlikely to reverse. No target recognition there, unlikely to reverse. What happens down here? This is Monday. This is the big blast down. Now you've got absolute target recognition. 15275 we're looking for as the Daniel Code blue line, and there it is, close enough, just a handful of ticks away. And you've got your stochastics oversold, and you've got divergence on your momentum indicator, i.e. this was a pretty good bar to get out on, and that's why I was scrambling on Monday night to get all of these charts updated for you. So they were all updated on the weekend, and then I ran them all again on Monday night for you so you could see this point specifically of these markets hitting these Daniel Code numbers with huge precision. Now, one of the even more interesting things about the Daniel Code, usually when you get these big bars, which people characterize as panic or margin calls or some other nonsense, you'll find that anything else you've been using apart from the Daniel Code will go out the window. Any ideas you have that there is other support and resistance other than the Daniel Code will start getting very fluffy. With the Daniel Code, the more the volatility, the more precise it is. It's precise all the time, but to see it hitting these numbers on these hugely volatile extended bars is pretty awesome. But that was the clue for me at least, and I was out at the close of Monday and pretty happy and enough to say thank you on that one. Here's the E-mini. It's showing you exactly the same thing. Here's our plus sell signal up here on on Wednesday of last week. Got in, right at the top. Down it goes, down it goes. No target recognition, no target recognition. That's not close enough. These things are precise. And look what happens here. Bang, it hits this blue line and runs away. Exactly the same thing. Here's the Russell. Here's the same thing again. This was in fact a TO3 sell on the Russell. Let me bring up my other chart here so I don't mislead you in any way inadvertently. TO3 sell signal was posted for Tuesday the 18th, valid for the 18th and the 19th. So it was nice. You knew about this a couple of days before, folks. So if you missed this trade, there must have been some reason for it that I'm just not aware of. So that trade was elected up there at 1210.7, all the way up there, and down it came. No target recognition, no target recognition, no target recognition. See, both of these red lines are not the red lines going down. These red lines are retracements from the low to the high. This is the chart I did on Tuesday. This is what I want to show you. This was the blue line recognition that we got on this market, exactly the same as the others. This was on the Monday. The low of that bar was 1071.6. We were looking for 1070.8, so about 6 ticks away, 6/10 of a point. So that's sort of like 0.0001, I think, but it's a very, very small margin anyway. Less than, well, one point, 10 ticks in this market would be 1,000th. So this was less than that. Okay, so this is 6/10,000 actually, and it's that target recognition. Look what's happening down here. I've got other charts to show you in more detail. Stochastics now oversold. This is a pretty good place to get out of your trade if you wanted to get out of it. If you didn't, you could have gone to a 1 bar stop and you'd have been stopped out right here today, a couple of ticks above Wednesday's bar. Either way, great trading, lots of money. This is the NASDAQ, same thing. I told you we got you short in every one of these markets. Same with the NASDAQ. Got you short in the right day, right at the top. Down it came. And I just wanted to draw your attention to why I have not posted the buy signals. I put a post in Forum a couple of days ago saying all of these markets were obvious buys. But look what happens with the buy. The way we trade off daily bars, to buy this bar here on the NASDAQ, let me get up to a chart so I'm telling you the right days. There was the obvious buy signal for Tuesday of this week. To buy that high, you had to put your stop below this low, okay? And the risk on entry was over $5,600 per one contract. And that's not the sort of trading that we do. This is the sort of trading that we do when we can get in with a nice risk management number and get the big trade. This trade up here, too brave for me and too stupid for me, because risking $5,700 odd on entry doesn't make any sense to me. It's way outside our risk parameters, and it's way outside the risk parameter at 2% for the vast majority of our clients. So these signals were all obvious. That's what this market was always going to do. And I put a post in forum that there were obvious buy signals on all these markets, but the risk parameters were just too far out. Same with this market. Here's the other one we were short last week. This is the DX, the US dollar index. This is a particularly good trading market because one of the things that affects profitability in trading is the relationship or ratio between the tick value and average daily bars, and also the margin. And the DX, because it's not one that's terribly popular with retail traders, tends to be more of a professionals market. It has a very high tick value to margin. Now, that's been eroded somewhat lately, but 6 or 7 years ago, it was just about the best market you could trade for that reason, that it had a small margin relative to its average dollar value daily trade. So that was the same thing here. Lovely rundown, great trading. And this was the target recognition. 92,465 was the number on the Daniel Code chart that I rushed and struggled all day to get out to you. And the actual low there on that day was 92.52. So just a handful of ticks away. That's your target recognition. Look what's happening down here. The fast stochastics oversold, the slow stochastics oversold, and you've got divergence on your momentum. Okay, the market's coming down, momentum is going up. This point right here is higher than this point here, which was the momentum reading for the previous day, and that's called divergence. So that was a classic blue line trade. That's how we define a blue line trade. First thing is blue line target recognition, short-term stochastic oversold, long-term stochastic oversold, and divergence on our proprietary CCI momentum indicator. That's what sets up the blue line trade. And I didn't even bother posting it because the risk-reward ratio, far too big. To buy this inside the bar, there was the buy. The next day is the inside bar. When you have an inside bar, you simply carry forward the last valid trade signal, which meant you had to buy above the inside bar. Or if you followed my normal advice, you bought before the last bar that was not itself an inside bar, that's not even this bar here from Monday, because there's a tiny gap above that bar, which means the true high of that bar is the previous day's close. So if I'd issued a buy signal, you'd be buying it at 96,005 plus 2 ticks, and your stop's under here. Too big, the risk is too big. If you did buy that, you'd have had 2 days up. You still wouldn't have even mitigated much of your risk so far. So, this is the sensible approach to trading. We've done this many times before. I've lived through many years. The Lord's been kind enough to give me enough years to live through the exciting times, the fun times, the crashes, the roaring bull markets. I've seen all this 100 times. For those of you who haven't seen it, it's great fun. Just enjoy it. Don't be frightened of it. Stick to your Daniel Code signals. I will keep you on the right side of the market, and I will not put up trades that are stupid or too risky or outside your normal risk limit. So with that in mind, it's sort of like lie back and enjoy the process. Here's our compliance statement, folks, which I'm required to show you, and I also urge that you pay attention to. There are all sorts of risks in trading, and the biggest risk, of course, is trading without understanding what you're doing or why you're doing it. So if you're trading and you're not already a member of the Daniel Code, I suggest that you join straight away. And if you'd like to do that, you can have a free trial of everything that we have, including our amazing Fourth Seal forecasting programs. And you simply need to click on the banner that says free trial at the Daniel Code website, which is www.thedanielcode.com. Create a username and password, then email Terry and tell him you'd like a free trial. Tell him what your username is. He will switch you on for a 30-day free trial of everything that we have. And you can then make up your own mind what's suitable for you and get learning about trading and trading. Okay, let's start on all of this work we have to do today, because we've got a lot to do. I'm taking you back here to 2000. Many of you, I know, traded through the dot-com bubble and the subsequent dot-com bust, but if you didn't, this is what you're looking at. 2000 was the height of the dot-com boom, in an era where websites were just developing. Great new products were there. Most of them weren't making any money, but they were, instead of counting dollars, they were counting eyeballs, and companies were rated on how many eyeballs they generated, how many people were looking at their product, and on the basis of that, these markets went up to pretty nice heights, and then we had the little mini crash. Well, it's a mini crash now. It was a big deal crash at the time, and that also finished up, don't forget, with the horrors of 9/11 in the middle of it as well. So I want to just show you what happened here and get you to understand this, because this is what you're looking for. These are what I call the tripwires. Now, this is a 24-day chart. Which is, the Daniel Code works on multiples of 6. 6 is the number of all markets, 6 trading days, and we run a 12 trading day chart. This is our 24-day chart. So it's pretty much the equivalent of a monthly chart, except it's more accurate because it's got some rationale to it. If you're just using a monthly chart, you're relying on the Gregorian calendar and wondering why the Emperor of Rome did that. And if you can tell me why that's got any relevance to trading, I'd be greatly interested. But this is the right way to do it. So the heavier blue line up the top, for those of you that haven't done this before, the heavier blue line running up here, that's the median of the Daniel Code trading channel. And drawing a Daniel Code trading channel has very specific rules, and there's a whole talk about this. Most of our tutorials, our webinars rather, and in much more detail, of course, at the tutorials, but there's actually a video of this. If you go to the Daniel Code website and search through the videos, you'll see a webinar I did on how to create these Daniel Code trading channels. And they're quite brilliant and absolutely lethal. So the thicker line, that's the median. The first line above and below it, there's the one above, this is the one below. That's 1 standard deviation from the mean. It's not the mathematical 1 standard deviation, the Daniel Code 1 standard deviation. The second line is 2 standard deviations above the mean. This line here is 2 standard deviations below the mean. And the price action at the close is what we're watching. Okay, so if we move along here and we get to this bar here, I'll just change back to my crosshairs so I can give you the date for those of you that want to look at this more closely. You can see there are no closes below the standard deviation all the way up through here. And this is starting back before 1996. Nothing closes below 1 standard deviation until we get to this bar here, which is the 24-day chart ending on 09/28/2000. We get our first close below 1 standard deviation from the mean. And that's our first warning signal. That's the first of our 2 tripwires. When that happens, we go on high alert to see what's going to come thereafter. This is still a trading market, and then 2 months later, December the 6th, we get our close below 2 standard deviations from the mean. Okay, so this first blue line below the thicker one is 1 standard deviation. This blue line here with its little red dotted extensions, that's 2 standard deviations from the mean. When we get a close below that, we get 1 standard deviation below the mean close. We assume the trend has changed. When we get a close below 2 standard deviations from the mean, that's our confirmation that the trend has changed. And don't forget, when we talk about trend, it's relative to time. You can't talk about trend without talking about time, because on different times charts, there will be different trends, and there are always multiple trends going on in markets. So what could be a downtrend on a 24-day chart could very well be an uptrend on a 12 or a 6-day chart or a daily chart. But bearing that in mind, the strongest of these charts, the longer the period, the stronger it is. And we don't spend enough time looking at these longer term charts. This is a 24-day chart, and there on December the 6th was our close, second close below the tripwires, but the first close below 2 standard deviations from the mean. And that tells us there's a high probability that the whole of that bull market is over. Goodbye. And once you get that breaching of the second tripwire, you often get a little consolidation, but the waterfall is near. And that's what this was. This was a roaring waterfall punctuated by rallies, and it was pretty dramatic at the time. So let me take this off, and then let's move on. That was the .com high, the 2000 high. This then, from there was the low, there was your low of that move. It all bottomed out in November 2002, and we started the next bull market. And this is the run up to 2007. And you'll see when this market ended here, in all of this run up here, this is where it starts. You don't get a single close below 1 standard deviation from the mean. Let me get my highlighter back so that you understand this entirely. This line up here, this thicker line, that's the median of the Daniel Code trading channel. This line under here is 1 standard deviation from the mean. And in all this time from 2003 to 2007, you do never get a close below this, okay? And the market just wanders either side of the median up to 1 standard deviation, back to the median, occasional visit towards 1 standard deviation below, but no close in this whole period, 2003, 2007, 4 years, until we get to this bar here. And then we get, for the first time, with this bar here, which happened in February 2008, on the close of that bar, we had a close below 1 standard deviation from the mean. That's our first tripwire gone. Okay, it's still a trading market, but that's our first signal that the trend has probably changed. The bull market is over. Then we got an inside bar, a rally back up, a test. You see this market will run up. It'll try and test these same lines. Really what you're looking at here is time and price. When you look at an angle on a chart, you're looking at time and price combined. So we had this little rally up, trying to recover the median. It couldn't. It got to 1 standard deviation and failed. And then look what happened here. It's not obvious, but look closely. June the 25th, 2008, we got our first close below 2 standard deviations from the mean of the Daniel Code trading channel. Okay? That was our confirmation that the trend was over. And when that happens, the waterfall almost always begins. And boy, what a waterfall it was. Down, 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 all the way down into this March 2009 low. So you've seen how this works. Let me show you now. We'll take that off and bring you up to date with where we are now. And we're starting to see exactly the same thing. Okay? Here's your 2009 low. Here's your valid Daniel Code trading channel. It's got to hold this first push out. It's got to make contact with one other point. And it does. I'm not sure. This is a 24. That's all quite valid. We could maybe back this off a bit until we got the bottom. There we are. That's even better there. We've now got the very bottom. This is the 1 standard deviation correction. As you can see, this is the only 2 standard deviation correction we've had since 2009. And this is now a very, very pretty picture. This is now correct. I'm sorry, this had moved while I was working the other chart. Here we have this market running up along the 1 standard deviation pretty nicely. And this is what happened here. Now, it's only at the median at the moment. It's gone down. It's hit the 1 standard deviation almost perfectly. It looks like there's a touch of daylight under this bar, so maybe a few ticks away. 1862 is my best estimate of where that one standard deviation line is. The low for this 24-day bar so far, 1867, not far away. So at the moment, this is a one standard deviation correction. That's what we're seeing on this chart. We're going to see different interpretations on the other charts. Helen Martin, yes, but those lines are drawn at the end of the period. They would have been in totally different positions along the way. That's right, but this has held this two standard deviation here, Helen, since 2011. It hasn't moved since then, because one of the features of this chart is that it's been holding this two standard deviation, and that's an important way of showing this. Now, I know you've been away a lot. You've been off skiing around the world in Europe and having a wonderful time. It's lovely to see you back here with us. But I show these charts pretty well, if not most webinars, then at least once a month. So that's what we have here, and you can see this Daniel Code Trading Channel has actually ended at May 2013, Helen. It hasn't been moved along since then because it's met its perfect requirements there. It hasn't had to be moved any further. There hasn't been sufficient price action to invalidate the Daniel Code Trading Channel. So you can see where this blue line ends is actually May 2013, and it hasn't moved on at all since then. Okay, let's go and have a look at the 12-day chart. Yes, we don't have anything terribly interesting on the 12, so we'll go straight to the 6, which we do have lots of interesting things to show you. And here it is. And this is the current run. We go back here. This is the 6-day chart of what I showed you before. This is the 2007 top. Here's your first close below one standard. Here's one standard deviation down here. You got your first close here in January 2008. Rally, 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 rally. And then you got your first close below two standard deviations in July 2008. Rallied 1, 2, 3, 4, 5, 6 weeks, and the waterfall begins. Okay, so that's the specific key that you're looking for. And you can see here what we've got. This is the valid Daniel Code Trading Channel. It's holding this 2-period correction here exactly. The one standard deviation is holding the first push out and another point, which it's doing. And what we have here is we have this is a 6-day chart, and this closed actually today, August 27th, was the end of this 6-day period. And as you can see, if you squint really hard, it's closed a couple of ticks below the one standard deviation downside channel. So that's our first clue that this trend, this uptrend, this massive bull market has ended. Okay, it's still a trading market, but the next thing we're looking for is a confirmed close, by which we mean a confirmed bar, by which I mean the close below two standard deviations from the mean. And it's quite a way away. Next week, it's going to be just about close enough to there. It's going to be around 1810. So that's what you're looking for. We've got now today, we can say that we've got our first breach of the tripwires. I'll blow this up a bit so you can see it. That's where the tripwire was for this week, 1998. We got a close 1987. That's our first close below the one standard deviation since way back at this bar back here in 2011. Okay, so that's our first clue that we say the bull market. There's our first clue. First tripwire's gone. The bull market could be over. We're now looking for confirmation of that. And confirmation of that will be a close on the 6-day charts, the first chart we'll see it on, probably, and that's going to be somewhere below 1820, a close of a 6-day bar. Okay, so now you know what are the specific things to look for. That's the stage that we'll start saying we have confirmation the bull market is over, But until then, it's still a trading market. Now, if any of that worries you, don't let it, because all you have to do, as I've showed you, is follow the Daniel Code signals. If there are going to be some good selling opportunities, you will get them from the Daniel Code signals. You will be short when you need to be short, and you will be long when you need to be long, if it is within our risk parameters. So following the daily signals at the Daniel Code is the way to go, but I also want you to be aware of these longer term pictures so you can have a better feel for your trading, what is and what is going to be. Okay, let's move on quickly. I'm going to show you gold, oil, Aussie USD, and the DX markets today. Let's move on to gold, because I know we have a lot of people who trade gold and are very interested in it. Here's our chart of gold. Nothing much changed on this gold chart from the last time we looked at it. Here was our fourth seal. Here was our price recognition on the close of this bar. Here was our hit on this red line, which is a fourth seal line that had been on there for some weeks. And here's the rally that we had called and expected. Now, we've had a few days selling off that rally, and my guess is that we are probably seeing a little bit of liquidation to meet margin calls. I'm surprised it didn't happen a couple of days earlier. We did get the reaction back in silver, which we often get. A lot of people use gold and silver, bullion and contracts as some repository of wealth. Nothing much to see on the 6-day chart. Nothing new at any rate. Let's go to the 12-day chart. Nothing on there. And then let's look at our major trend chart, which is the 24-day chart. That's much as it was. The point of this is gold is still in a very, very strong position. Bring in some data here, and you can see, I mean, gold's sitting way up there. All it's done is it's corrected 108.85, the number in the slightly darker red. That's simply a 50% retracement of its operating swing, which is from the high back to this 2008 low. So, it's still in a very strong position. Don't be too gloomy about gold. It's in a strong position, and we'll let you know what's going to do. 62 is normally a support cycle in the Daniel Code timing cycle. 62 is the one. It normally gives us lows. So that's coincided with this rally now. That's, all pretty much as we've said. I think I showed you the gold chart a bit earlier. We've been on the right side of everything in gold all the time. Oil is one we talked about last week, and I think it's very interesting. I've had a number of people ask me to clarify what's happening in oil. This is the 24-day chart of oil, and you can see where it's come to, straight down to its blue line number. On the 24-day chart, it has a blue line at 37.66. That's not apparent on the daily charts. As I said, with different charts, you have different groupings of patterns, and it's these patterns that are called matrices, or matrices in America, I guess, that actually create the Daniel Code blue lines, which is why, if you ever want to get really seriously very, very, very good at this stuff, you need to keep charts of different time cycles. I run daily charts, 6, 12, and 24-day charts, and you can pretty well see everything. But, you need to be a professional full-time trader to make that commitment. I know some of you are. Those of you who are also, or who would like to be, don't forget that we are organising the next tutorial at Waiheke Island in New Zealand in the first 10 or 12 days of December. So put that in your diary. It's the most beautiful place. A lot of you have been there before. It's an island in the Hauraki Gulf of New Zealand, which is the big bay that Auckland sits on, which is the main city in New Zealand where you'll fly into. And it's about a 25-minute ferry trip across to Waiheke Island. It's It is a paradise. If you ever thought of coming to this part of the world, that's your chance. And you should, if you want to be good at this stuff, the only way to be good is to come to a tutorial. If you've already been to a tutorial, come down to Waiheke. You need to do 2 or 3 or 4 or more. I think Sage and Daryl, who are with us, have done 6, 7, maybe even 8. I'm not sure. But we'll look forward to seeing you in Waiheke Island, New Zealand, early December this year for a tutorial. I'll show you how to do all this stuff for yourself. So there was a 24-day chart. We needed to also look at the 12 on oil. CL, this was here we are. I showed you this chart. I've been showing it to you for the last month and a half. And you've seen these numbers on it. The last time I talked to you, we had a break of this 50, and the next number on the chart was 38.22, and the one after that's 31.44. In fact, a couple of you, including Rod, lots of tutorials, says Sage. Yeah, go, babe. Just excuse me, folks, for a minute. Thank you. Take off a sweater, which I put on early this morning, but it's warmed up here so much now. I'm actually that's come off, and I'm thinking that it's going to be a lovely, lovely day. We're just early spring here in Australia, up north at Gold Coast of Australia, the playground, and it can warm up here pretty quickly. So we had that number. A couple of you emailed me, said, "Look, I saw it on the webinar, but I didn't write it down." These are all recorded, folks. So unless something goes wrong with the recording, which has happened in the past, it'll be posted on the website within a couple of days of the webinar, depending how quick Terry is to post it. And sometimes he's very quick indeed. So you can always rerun this. But that number's been on this chart for months and months and months and months. I even went so far for you members as to put it on your daily members charts. It doesn't come off the daily chart, but if you want to take a look at the members chart, you can see, which I can actually show you all here. If you haven't seen these charts, you should know how great they are. Let's pump this up for you. I don't want that. I want this. Okay, so we can get it this way. Here's the Daniel Code website, and you can go to members charts, and this is oil will be under miscellaneous, crude. It should open, and here's the chart. So this shows you all the blue line numbers, where the market's going, and 2 weeks ago, I actually put this on 38.22 and said this is from the daily chart. And for those of you who trade oil, on Monday, the close of this market was 38.24. And that's what's caused the rally. You had target recognition. You had the slow stochastic oversold, the fast stochastic oversold, divergence on the momentum indicator, but the target recognition came off the 12-day chart. It's still valid. In fact, that's how all this stuff works. So that's how accurate this was. The close there at the low was 38.24, the low bar on Monday. So that was pretty nice. Rod, you were one of the guys who wrote to me and said you'd missed that number. Okay. All right, next number down, 31.44, and I think we can look at that. We've done I think we did the 12 and the 24, that's the 12. Let's just have a quick look at the 6, see if there's anything more to learn, and CL2. Okay, interesting. Here's the 6-day chart. And you can see it had a different black line number because it had more swings on it than are apparent on the other charts. And it went straight through there. You got target recognition of this number, 42.49, way back on August the 14th, a break, and now it comes back, testing it from the low side. But all you need to do is be aware of the Daniel Code signals. We had buy signals on this market for Tuesday, the 25th. It was an inside bar. You carry it forward. We had another inside bar. The program we have here won't carry forward 2 inside bars, but as I've told you before, with an inside bar, just carry forward the last valid signal, and you got a nice reward today with a decent up move in oil. Okay, that's all done. The next thing for me to look at, we've done the equities, we've done gold, we've done oil. I want to show you the Aussie USD because this is a source of perpetual amusement to me. This has been, we'll go to a larger chart in a while, but this has been the most overvalued and recklessly managed currency in the world. This is the six-day chart, and we've been having this endless burble from 34 economists think this, and 32 analysts agree this, and none of them have got a clue. From way up since the 80s and 90s, all they've had to hang their hat on is, the Reserve Bank would like it to get to 75. Well, it didn't even care about 75. 75 is just a nothing number for this market. The most you could say is, there's a low at 75.33. But what actually happens is it's tracking these Daniel Code numbers absolutely perfectly. Here's its first pull out. It hits this 95.73 number and rallies. It goes down. We've only got one set of numbers here. I'll show you another chart with 2 sets of numbers. This one drops down to the 88.22, rallies up, back up to 95.73. Same thing comes down. You get your target recognition is valid at the close of a bar or the bar high low. This is the close. This closed at 88.20 against 88.22. Rally, same thing. Held it here for 3 weeks, down it goes, same thing, held it here for 3 weeks, down it goes. There is a number here, but it's from another chart. Rally up to retest the 80.71. Now we get this break of 73, and it's like, oh my God, where's this market going to? Well, you know where it's going to. It's going to one of these numbers. There's 65.64 on the 6-day chart. Let's see if we have any information on the 12-day chart. And even if you don't trade this market, here you are. This is the one with the 2 sets of numbers. Just have a look at this. That's target recognition. That's target recognition. That's target recognition. So's that. So's this one. Little rally up here. Hits this number. Stops it for a week. Goes down 2 numbers. Stops it for another week. Goes down. Stops it for another week. Down here. A bit ambitious. Doesn't quite get the number. Shows it's a bit more bullish. Rallies back up. Okay. Continues to go down. Hits this number, stops there for the week, closes there for the next week. That's 2 weeks. Now you've got the break. Where's it heading? 67.79, then 65.54. All right, so if you're a Daniel Code member, you should have this little guy, Dan, here on your toolkit. It's called the Daniel Code Library. It's free to all of our members, and you use all you're seeing here with these red and black lines are those retracements from this Daniel Code retracement tool. These are not fib numbers. They're not old highs or lows. There are proprietary numbers and ratios that rule all markets all of the time. So if you don't have this, you shouldn't be trading because you're probably not doing terribly well. The best advice I can give you is learn how to trade these Daniel Code numbers and ratios. Norbert, can I show Canadian US chart? Yes, I can, Norbert, but it won't have anything on it. If you would like to email me, or any of you would like to email me, jneedham@thedanielcode.com, and tell me what it is you're interested in, I can prepare the charts to show you at the webinars. The reason is that these charts live on a number of different machines, and to get them on the machine I use to do webinars with you, I have to have them prepared and bring it across so I'm ready to show you. But you're interested in that, Norbert? I'm more than happy to do that for you. So here's my email address. If you jneedham at thedanielcode.com. jneedham at thedanielcode.com. Shoot me an email of anything you'd like to know going forward, and I'll be more than happy to have that prepared for you for the next webinar, which we do every fortnight, sometimes more frequently. But I wanted to get this to you today, so those of you reading all this news coverage on what's happening with these markets and flash crash and market limit down. Don't forget, with markets, all of these futures markets have a limit, which is a maximum amount they're allowed to move in a period of time. And when they hit that first limit, the markets are usually suspended for 10 minutes. Then they resume trading. If they hit the next limit, they're suspended for an hour. If they do it the third time, they're suspended for the whole day. And those rules vary between different exchanges, incidentally. But the theory of that is that a lot of these big crashes, whenever it happens, people lose money because stock traders don't really know what they're doing. They're all into buy and hold. They lose money, they scream. It's a pretty normal human reaction. And then there's an inquiry. How did this happen? And because the people who are doing the inquiry don't understand much about trading either, they usually finish up with something that nobody else can prove or disprove. The most common one is, it was machine trading. Machines, automatic machines searching for bids and ask against other machines, and they don't really know what they're doing in the market, so they keep searching for the next bid, and it's going down, it's down, it's down, and that's what causes these crashes. Of course, that's all absolute rubbish. If that was true, then how is it that the Daniel Code manages to forecast all of these big market moves, usually a day and sometimes 2 or 3 days ahead? So there's the answer to that. But that's why we have these suspensions or breaks in trading, limit down, the market stops trading for a period. Hopefully their theory is everyone rushes to these so-called rogue machines and tells them stop being a naughty boy and stop selling and start buying. I mean, it's just absolute rubbish, complete rubbish, because if that was true, how is it that we keep forecasting these moves before they happen? Here's, let's have a look, John. I took the long on oil in your tutorial. This is a counter trend rally. See this, guys? Here's Mike Metsos. He's a dentist from Chicago. He's not in Chicago. That's where he's from. Big tough guy. Real. You should go to the Chicago council or local government, Mike, and tell them to use you to promote Chicago. You're the real archetypical Chicago guy. Lovely, lovely fellow, Mike. We had so much fun at Los Angeles with Mike and these other guys. We did all of our tutorials just are great experiences. Mike, anyway, he took the long trade in oil today on what I taught him at the tutorial. My question is, because this is a counter trend rally, what should it last 1 to 3 days? I exited today on the close. Was that correct? Or should I be trailing the stop? I still struggle with these exits on winning trades, which are plentiful with Daniel Code. Mike, absolutely right. Let's pull that chart up for you. It is a number one problem. When do you exit on these winning trades? So here is oil. Let's see what happened. This actually was there was a buy signal for Tuesday, August the 25th. And Mike, because he's done a tutorial, knew how to create them for himself anyway. And if you get signal for the Tuesday, you have to carry it forward. We got another inside bar. You then have to carry it forward. Now, our trade program at the website won't carry forward after 2 inside days. That's just a limitation in the technology that I have. But I've told you this often enough. I hope many of you did. Those of you who've been to tutorials, as Mike says, knew it was a buy anyway. So The question is, do you exit first profitable close? Well, yes, you certainly can. There's a nice profit in that. If you bought round about the high of the inside bar, Mike, there was 25.80 or so profit for you. If you bought at the high of the last bar that was not itself an inside bar, which is my preferred method of entry, there's close to $2,000. So that's a nice trade, really easy, great, I love it. If you wanted to hold this trade, you have to use the 2-bar stop into the 1-bar stop. And at the moment, it works off this fast stochastic, the 533 stochastic, which is nowhere near overbought. So your last 2 completed bars, there's 1, this is 2. So you'd have to have your stop 2 ticks under this bar here. The low of this bar is 38.52. So your stop would be sitting there at 38.50. Now, what's the answer to your question? It's really a matter of personal preference. If you want to hold these trades longer, you can, and just use this mechanical 2-bar into 1-bar trailing stop. If you're happy to take profits first profitable close, do it. It's just a question of your temperament, and that's all it is. We can look at this in far more detail, and we can say, wow, look, this has had a huge, massive rundown, massive rundown, massive rundown. This is almost certainly only a counter trend. Against that, I can give you the argument that it hit the black line on the 6-day chart. We had that's very, very strong number that's been on the chart for a long time. It is probable that this is at least an intermediate low, which means we should have a number of weeks up. Okay, what's the right answer? That's just opinion. There is no right answer. We do not have knowledge of the future. So the key to this stuff, Mike, is to do what you're comfortable with and stick to it. Either way will be fine, and over a long period of time, you'll find that you actually get very similar results. When you've got a market, for example, that's doing this through here, this sort of stuff here. When you get a market doing this, exit first profitable close is absolutely great. When you get a market doing this, here's the big rundown. Look at this thing. It's just been in this massive downtrend. This, you wanted to hold these trades longer. How can you tell? You can't. But if you have a disciplined approach to this, whatever you do, they both ways will work out about the same. But the main thing is you have to be comfortable with it. Okay, I mean, I can tell you that as you walk back through this, we can have a look at where our retracements are. Remember, this contract rolled over, so this is just an estimate. But there's the first major swing there. Does that look valid? Yes, look, it hit this number 42.99 perfectly. So this is the sequence that it's tracking. We can take those 2 off. It's blown them. And there you are. So my answer to your question, the hardest part of trading, are you a first profitable close trader, or are you stay in the trade trailer? It just depends exactly on what sort of a person you are. There are some people who get really upset when they get a big bar like this. They don't get out first profitable close. It reverses tomorrow. And anything can happen in trading. We know that. And they say, oh, God, I had all that money. I've lost it. That's one emotion. The other emotion, which I'm a sucker for, I hate being out of the market when there's a big move. So I'll tend to stay in a market until I get a sell signal in this case. I'm long this market. I'm still long. I hope it's going higher, but I don't know that it's going to go higher, and nor does anyone else. And I do implore all of you, if anyone tells you they know what's going to happen with the markets tomorrow, run away as fast as you can. They don't know. Okay? Nobody knows. That's why this is the business of probabilities, and all the rules we use and all the studies and indicators we have are pointing you towards the highest probability, but they don't know. I like this trade though, Mike. There was our rollover of contract. This ran a bit further. Rollovers are really great times for changes in trend. I'm wrapped in that black number we had from the 12-day chart. That's much stronger than a number on another chart. You're out. You tell me you've taken your profit, you've exited. Great, count the money, enjoy it, and let's just see what unfolds from here. But that's good trading, and this was a nice trade. You see, you come to your tutorial, learn how to do this stuff. Look at this. Wow, 2,700 per one contract. You've all probably paid for the tutorial many times over already. So that's the answer, Mike. It's what suits you. But the main thing is, whichever you decide, stick to it. Do the same thing again and again and again. Don't chop and change. Okay. All right. So I have one more question here from my old friend Akshay. Over in India there. Hello, Akshay. Lovely to hear from you. Does the CCI indicator include inside bars? Yes, it does, but our stochastics do not, Akshay. The Daniel code, the biggest cause of incorrect readings in stochastic CCI indicators and everything else are inside bars, because sometimes they're nulls, they're waiting for time to expire. Sometimes they just mean nothing. There's a lack of momentum to push them one way or the other, and we don't know which is which. So for the Daniel code stochastic studies, the difference with them is they are designed so that they ignore inside bars, and they ignore inside bars. The CCI, we haven't been able to do that with, because it's not my proprietary study. It's a public study that I've adapted to make it work. CCI actually stands for Commodity Channel Index. It's very old. The default setting on it's 100 periods. It's supposed to track commodity market movement. It doesn't. It's completely and utterly useless. I found it and fiddled with it and played with it, and I've changed it into a momentum indicator. And the way we use it is very good. And Mike, as you can see here, boy, there's no divergence on this bar up today. It's a beauty. Okay, Akshay. This from my very good friend Sage. Fan webinar, John. Lots of great charts, such good advice, both for new traders and those of us who love this stuff like it's a bedtime story, all warm and comforting. I'd like to be warm and comforting with you, Sage. I hope Daryl's happy and bright today. I know that he knows that I adore you, but he probably said it to you already. All really exciting too. Thank you, darling. I'm glad you enjoyed it. We don't get a whole lot of compliments here, but I'd love to have them. Thank you very much. Well, that's great. Folks, I have to say goodbye to you now. We're 10 minutes past our allotted time, and I've got two big, good-looking gentlemen out here, Gareth and Luke, who've done a wonderful job starting work while being as quiet as little mice, but I've got to turn them loose and let them start using hammers and saws and noisy things. So thanks for your attendance today, Sage. Lovely. You too, darling. Have a good one. DX, Bill Ford. Why did I miss DX? Gosh, let me get to it in 10 seconds. Bill, thanks for that heads up. I did want to show you DX because it's pretty fantastic what it's been doing. It doesn't appear to be 12. Where am I? DX, there's a 6 I want to show you and a 24. We'll rush this. Thank you, Bill, being alert. DX. There we are. This is the DX, folks. Have a look at this. What a beauty. This market rallied, been rallying big time. Here's its lows down here. This is the Daniel code numbers again. Same thing. Look what happens. It runs up into these numbers, ignores this number, ignores this number, ignores this number, goes up 2 bars, says, whoops, sorry, comes back, this little bar here. I'll spread this out so you can see it. This little bar here, 0209, this is on our 6-day chart, comes back and sits right on that Daniel code number. That's the 44% number, and it's doing that for purpose. It's saying, hey, I know what these numbers are. It did it here the first time. It closed right on this number, 85.95, closed exactly at 86.03. It's saying, hey, I know what these numbers are. I'm paying attention to them. It ran right through this number, stopped just below this one, found support, 93.39. Against that low, 93.38 and a half a tick difference. Used to be the tick. They've split this up so it trades in half ticks now. Up it went, whoosh. Here's our 59% number at 100.83. The high of this bar is 100.785. Absolutely perfect target recognition. The 59.3, that's the strongest of the Daniel Code numbers. And now it's consolidating. It ran down here. It bounced off the 93. Little rally up, another test of the 93. This time it's broken through it, and this is what I call an oops, sorry bar. Went too far and said, oh my God, I shouldn't be there. It's running back up to get back to 96. So at the moment, this is consolidation, but it's tracking these numbers perfectly. Let me get to the 24 really quickly, and the DX on the 24. And you see the same thing, a bit better view of it here. This is you had the this is the 37.5 number, happened to be right at the old high from the low. Run up, run up. Here's the 59 number, 184, same number on this chart. So we're getting a consolidation here. How much further will it go? Well, there's its next two targets. If it breaks higher on this big chart, 108, then 115, go to the Daniel Code chart on the members charts, Bill, and you'll get all of the numbers as it goes. So thank you for reminding me. Brian Coleman, thank you, mate. Glad you enjoyed it. Talk soon. Maddie, glad you enjoyed it too. MSN, my friend, probably, and Bill. Okay, guys, I've got a bolt. Thank you for your presence in your company with us today. Chip. Not quite as warm. No, Chip, you're not as warm and fuzzy as Sage, I'll tell you. You'll meet her. Come down to Waiheke and say hello to Sage and the rest of the team. Good on you. Don't forget, we've got to get you and your mate up to speed on all this stuff. Let me know when you're free. Bill, you're welcome. John Listman, thank you. You're very welcome, guys. I have to close this so these fellas can do some work. Thank you for your attendance, folks. Look forward to seeing you at the next one. Do email me, please, jneedham@thedanielcode.com, jneedham@thedanielcode.com, if there's any particular market that you'd like me to talk about or analyze with you. Enjoy your weekend, folks. Bye-bye.